So on July 1st, Brigham Young Corporation purchased Brigham. I can't go to BYU. I've just been voted off. I wish I could go there. Then I would never have. I should have gone there then instead of UC Santa Barbara. My liver would still be okay. All those great things. So Brigham Corporation purchased Young Company. That sounds like Young's Markets. That sounds like an alcohol distributor in Orange County, by paying $250,000 cash and issuing a $100,000 note payable to Steve Young. Ooh, quarterback. At July 1st, gotta get those good references in from the early 90s. At July 1st, the balance sheet of Young Company was as follows. So we ignore equity of the shareholders, but we've got cash, AR, inventory, land, buildings, net, equipment, net, trademarks, and then accounts payable. Okay, so my book value, let's make sure this adds up to 435. Okay, so this is what's on my books. The fair value, so the recorded amounts all approximate current values except for land fair value of 60. So everything else is going to be the same. Okay, and that difference there is 20 grand. Perfect. Okay. So let's see over here. So recorded amounts, I'm sorry, except for land, inventory has a fair value of 125. And the trademarks have a fair value of 15,000. So I missed those two. So the fair value are all current except for land, which is at 60. Trademarks, which is at 15. And inventory, which is at 125. Okay. So prepare the July 1st entry to record the purchase. Okay, so what we're going to be doing here is I'm getting cash, AR, inventory, land, buildings, equipment, trademarks. Cash, this is all going to be reported at fair value. Okay, and then I'm going to have over here accounts payable of 200,000. Now I'm not getting all of this stuff for free. I'm paying $250,000 cash and I'm issuing a $100,000 note payable. So the net fair value of these assets, remember I disregard owner's equity. The net fair value of these assets is 285. My consideration, I have cash of 250, a note payable of 100,000. So my total consideration here is 350,000. When I compare this to the net fair value, the difference between these two amounts here is going to be my goodwill. So for this transaction, I'm going to have goodwill of $65,000. So I'm just going to put this here, goodwill, 65,000. So my other parts here is I'm giving up cash, call this cash to seller, and then note payable. So when I have the cash going out at 250, the note to the seller of 100, when I add up these different amounts here, I'm balanced. Okay, so this is to record asset purchase. Now, the last thing that this is asking me for is prepare the December 31st entry to record the amortization of the intangibles. I've never seen a residual value, but I guess it has one. So what we do here for letter B is my trademark. So over here, the value of my trademark is now 15,000. It's not going to be 10 grand. It's 15,000. And let's see here. Yeah, they're subtracting it out. So basically they're taking the trademark minus the residual value divided by the estimated useful life. So this is going to be 15,000 minus 3,000 divided by 4, or 12,000 divided by 4, or $3,000. Now this is for, though, this is going to be for a full year. Remember, we bought this on December 31st. So I'm going to have here amortization expense for my trademark is going to be 1,500. Or I can just basically credit the trademark for 1,500. And this is going to be 12/31/20. Okay. Why is this 1,500? Because we use the trademark from 7/1 to 12/31, or 6 months. So 6/12 times 3,000. Okay. So thank you for joining me here on my continuing accounting odyssey. We're almost getting to the real exciting part, which is going to see how many of these questions I end up dropping once I figured out how much work I did for myself. I have selected 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 16. A little bit too many from chapter 17, but we'll see how many I do. It's going to be exciting. So you can kind of see this as it gets formed. Anyways, thank you for joining me here today. I look forward to seeing you on the next video. Have a great one.